If you own gold or silver, pay attention. The Fed just broke a 14-year pattern. Silver just flashed a signal that has appeared only a handful of times in modern financial history. And it didn't come from a chart. It didn't come from a mining report. It came from 4 words spoken by a man who has been the head of the Federal Reserve for less than a month. Kevin Warsh stood in front of the world's financial press, and instead of doing what every Fed chair has done for the last 14 years, he did the opposite. He took a policy statement that normally runs over 300 words, full of careful hints about what the Fed might do next, and he cut it down to about 130 words. The statement was roughly 130 words, down from figures above 300 recorded in recent meetings, according to a CNBC analysis of the releases. That might sound like a small editing choice. It is not. It's the end of a system that Wall Street has depended on since the aftermath of the 2008 financial crisis. Quick question before we go further. If you had $10,000 sitting in cash right now, would you move it into gold, into silver, or would you leave it exactly where it is? Comment below. I actually read these. By the end of this video, you're going to understand exactly why removing a few hundred words from a Fed statement could matter more to your silver stack than the last 3 rate decisions combined. And there's one detail hiding inside the dot plot that almost nobody has connected to the metals market yet. Stay with me, because that detail is coming. Here's where it gets strange. For the better part of the last 14 years, since the Fed first started leaning heavily on what economists call forward guidance, every FOMC statement has followed the same unwritten rule. Give the market hints. Tell investors what's coming before it happens. Soften the blow. Manage expectations. This is a fundamental change in how the Federal Reserve communicates, and therefore in how markets must price Fed policy going forward. Warsh didn't hint. He said outright that forward guidance, in his words, was not well suited to the current policy conjuncture. Pause for a second. Think about what that actually means. For 14 years, every hedge fund, every pension manager, every retail investor with a Robinhood account learned to read between the lines of Fed statements. That entire skill, that entire industry of Fed watching, just got told it's not needed anymore. One BlackRock fixed income executive said the Fed had ushered in a new era of monetary policy in the United States. That's not a small comment. That's one of the largest asset managers on the planet telling you the rules changed. Do you think the market is underestimating how big this shift really is? Let me know what you think. But this isn't even the biggest story, because while everyone was talking about the shorter statement, almost nobody noticed what was buried in the numbers underneath it. 9 of 18 FOMC participants now project at least 1 rate hike before the end of 2026. Half the committee, not cutting, hiking. And meeting participants were split, with 8 expecting no change, 1 seeing a cut, and 9 anticipating at least 1 hike. At the same time, the Fed's own inflation forecast moved in the wrong direction. The Fed's own 2026 core PCE inflation forecast was revised upward to 3.3% from 2.7% in March, with the headline PCE forecast rising to 3.6%. And in the real economy, the Consumer Price Index for May showed a 4.2% annual inflation rate. Read that again. Inflation is still running well above target, and the Fed's response is to consider raising rates further, not cutting them. Most investors stop their research right here. They see rates might go up and assume that's automatically bad for gold and silver. That's the old way of thinking, and it's about to get more complicated. Retail investors watch headlines, professionals watch positioning, and the position the Fed is in right now is one economists have a name for. At first, this doesn't make sense. Why would a Fed chair, known for being hawkish on inflation, risk hiking rates while the economy is already showing cracks? Here's the uncomfortable part. A Fed committed to delivering price stability at any cost. In an environment where the primary source of inflation is a supply shock it cannot address with monetary tools, is a Fed that may inadvertently tighten into a slowing economy. That is the textbook definition of a policy error, and historically, Fed policy errors have been among the conditions associated with significant moves in gold, whose price reflects macroeconomic consensus expectations and economic uncertainty. Would you have expected that? A hawkish Fed chair, one everyone assumed would be bad for metals, might actually be setting up the exact conditions that have historically sent gold higher. Here's where I need your opinion. Do you think this ends in a soft landing, or do you think the Fed is about to tighten into a slowdown it can't see yet? Debt problem nobody wants to say out loud. And then something unexpected gets added to the equation. Every single rate hike doesn't just affect mortgages and credit cards. It affects the US government's own borrowing costs. Warsh's hawkish stance increases the cost of servicing a $39 trillion national debt, and every rate hike adds hundreds of billions to the annual interest burden, accelerating the fiscal deterioration that is itself a structural driver of long-term gold demand. Think about that for a second. The Fed is trying to fight inflation with higher rates, but higher rates make the national debt more expensive to service, which pressures the government's finances, which is one of the exact conditions that has historically pushed investors toward gold and silver as protection. It's almost a loop. Fight inflation, worsen the debt problem, strengthen the case for the very metals you're holding. If this all feels complicated, here's the simple version. Imagine you're paying off a credit card, and every month the interest rate on that card goes up because the bank is worried about inflation. The higher the rate goes, the more of your paycheck goes just to interest, not the actual balance. Now imagine that credit card is the size of the entire US government's debt. That's roughly the situation the Treasury is in every time the Fed hikes. But before we continue, there's something important that almost nobody is talking about. Warsh didn't just shorten one statement and walk away. Warsh laid out a plan to launch 5 task forces that will examine the Fed's communication methods, its balance sheet, its reliance on existing data sources, its inflation framework, and productivity and jobs in an era of AI transformation. That's not tinkering, that's a top-to-bottom rebuild of how the most powerful central bank on earth thinks and communicates. One independent researcher called it a sea change from what previous chairs have done, noting that prior chairs tried to give the market as much of a heads-up as possible before any change in direction. Warsh is removing that heads-up system entirely, which means going forward, markets, and that includes gold and silver, may start reacting more sharply and more suddenly to each individual data release, because there won't be months of hints to soften the surprise. If you're enjoying this deep dive, hit the like button. It genuinely helps more people find this kind of macro breakdown instead of the surface-level headlines everyone else is repeating. And if you want to understand what happens beneath those headlines before the crowd catches up, consider subscribing. That's exactly what this channel is built for. Now here's where this connects directly to the metal a lot of you are actually holding. Silver doesn't move exactly like gold. Gold reacts almost purely to monetary policy, debt, and currency confidence. Silver carries all of that same weight. Plus, it's tied to industrial demand, solar, EVs, electronics, and increasingly, AI infrastructure build-out. So when uncertainty rises around Fed policy, silver often gets a double pull. The monetary hedge demand that gold sees, plus whatever is happening in the industrial economy. If this new no-forward guidance approach leads to sharper, less predictable market reactions, the way several analysts are suggesting, that kind of volatility has historically been fertile ground for silver specifically, because its market is smaller and thinner than gold's, and thinner markets move harder in both directions. What I'm about to show you may completely change how you think about the rest of this year. Warsh himself didn't even submit a personal interest rate projection. He declined to submit his own dot for the projections, citing skepticism about the utility of forward guidance tools, effectively withdrawing the Fed chair's personal guidance from the market's toolkit. Sit with that. The single most powerful person in monetary policy, the man whose opinion used to move trillions of dollars in a single sentence, deliberately chose not to tell you what he thinks is coming. There was rampant speculation heading into the meeting about whether Warsh would submit a dot at all, and he confirmed that he did not. That's not an accident. That's a signal in itself. It says, don't expect me to hold your hand through this. Watch the data, because I'm going to react to it, not tell you about it in advance. Most people see chaos in a move like this. Smart money sees a signal. A Fed chair unwilling to commit to a public projection is a Fed chair who believes conditions are unstable enough that any promise could turn out wrong within weeks. Now, I'm not going to sit here and promise you a number. Nobody honest can. But here's what the probability starts to look like if these conditions persist. If inflation stays elevated while growth slows, historically, that combination tends to increase the odds of a policy misstep. If a policy misstep happens, the math starts pointing toward the exact environment that has supported meaningful moves in gold in past cycles. Under a slowing economy, some analysts see gold gaining somewhere in the 5 to 15% range in 2026, while a severe downturn could drive a move in the 15 to 30% range. That's not a guarantee. That's a conditional range from analysts watching the same data we just walked through. Silver, historically, tends to amplify whatever gold is doing, for better and for worse. And this final piece may be the one that connects everything. There's one more layer of tension sitting on top of all of this. President Trump has publicly stated that the Federal Reserve would be wrong to raise interest rates, citing the negative impact of higher rates on economic growth. So picture the setup. A new Fed chair, deliberately withholding guidance, sitting on a committee that's leaning hawkish, with inflation still running hot, a national debt north of $39 trillion, and a sitting president publicly pressuring him in the opposite direction. That is not a stable, predictable environment. That is the kind of environment where markets get surprised. And metals, historically, do not hate surprises the way stocks do. Would you have expected a brand new Fed chair to be this willing to publicly disagree with the White House in his very first month? So this isn't simply about a shorter Fed statement. This isn't just Kevin Warsh trimming a few hundred words out of a press release. This is the first visible sign that the entire operating system of the Federal Reserve, the one investors have relied on to anticipate moves since the aftermath of the 2008 crisis, is being dismantled and rebuilt in real time. A hawkish tilt, a missing dot, 5 task forces rewriting how the Fed thinks, a rising debt burden that gets more expensive with every hike, and a chairman who has made it clear he'd rather surprise the market than manage it. Individually, each of those is a data point. Together, they start to look like the early stages of a genuinely different market regime, one where the old playbook for reading the Fed simply doesn't apply anymore. So here's the question. Is this just another Fed chair putting his own stamp on communication style? Or is this the early sign of something far bigger, reshaping how gold and silver behave for the next several years? What happens at the next FOMC meeting could tell us a lot faster than anyone expects. If you made it this far, you're already doing more homework than most people who own gold or silver right now. I'd genuinely like to know what you think happens next, so drop it in the comments. I read every one of them. And if you want to stay ahead of moves like this before the mainstream financial media even notices them, subscribe and turn on notifications. Because sometimes the biggest opportunities appear long before the crowd even realizes something has changed.